our year-end wrap-up, 2020 investment review and outlook. We're recording this on January 7th. We've just over the last day, there's been lots of craziness out there. You've got the Georgia election results, and then, of course, everything going on in Washington. And we're not going to dwell on that today, but, by the time this is posted, I'm sure there'll be more news and more things that have happened. But we're not going to focus on that, right, Gary?
Well, that's not our plan. Yes.
Okay, good. Sounds good. Well, what we are going to focus on is just looking back the last year. 2020 was an interesting year for sure, and looking at it specifically from the markets, and then as we look ahead. But Gary, it's been a while since I've seen you. How's it going?
It's going pretty good. Santa Claus didn't throw me out of the house, and I actually got some nice gifts.
Oh, good.
And so, yeah, and it's pretty good, except I'd rather be somewhere down south where I could be sitting outside while we're doing this rather than me sitting inside in a sweater.
That's right. Well, I talk to Eddie every day down in Orlando, and Eddie likes to show off his t-shirts and polos and things that he's wearing, and say, I wonder what the temperature is up there, Ben. So no,
Eddie is a sick young man.
Absolutely.
That's all I can say. That is terrible.
That's right.
I've got to talk to him and tell him he needs to clean up his act.
Feel free to call him as soon as we're done. So great. Well, before we jump in to the charts, and we've got a lot to go through, this will probably be a little bit longer than our normal meeting, just because it is looking at a full year and looking ahead. Is there anything you want to start off with?
Well, forgetting politics, but boy, was last year a roller coaster ride in the stock market and in the economy as far as that goes.
Mm-hmm.
Boy, we spent the first 6 weeks thinking everything is great and it's all fine. And I am thinking about heading to Arizona for spring training. And then, boom, the roof fell in.
Absolutely.
And no trip to Arizona, and the stock market crashed. And we had this little thing called the coronavirus that, boy, hit us right in the chops and knocked us all out. So, boy, what a year.
Absolutely.
There are, as I've heard, there are years when nothing happens, and there are years when decades happen. And boy, did last year hit us on that one. And this year we're starting off with
a bang, that's for sure.
I was hoping that things would calm down in 2021, but boy, what can we say? This is kind of crazy, and I'm certainly hoping that we can get things calm down here, politically, and that economically we can get things going better, which we already are.
Mm-hmm.
We're having a nice recovery, although we certainly haven't come back up to what it was before last February. But I think we are on our way, and I think things are getting better. We just hope that we can get people vaccinated as soon as possible and get particularly these small businesses, restaurants and so on, that have just been decimated, much worse than any other part of the economy. And the ones that we have a chance to save, I hope that we're able to do that.
Mm-hmm. Absolutely. We're going to focus most of the discussion about the stock market and the bond market and the publicly traded markets. But I think you touch on a really good point, which is, and we talked about this all last year too, the market is so different than the economy in this case in terms of what we're seeing. We know the stock market had a great year. I would say economically, we know it wasn't great. You take small businesses, particularly, as you said, that's going to show in the data as we go through and the next couple quarters. That's going to all show up, and we're nowhere close as an economy back to where it was January of last year. So
Yeah, that's for sure. But we are getting better. That's something
Absolutely.
that I want people to also understand. It's nowhere near as bad as it was, April, May, June of last year. That second quarter, I think the economy was down, what, 33% in one
Right.
quarter.
Right.
I mean, that's just astounding.
It's unprecedented. Right.
Yeah, that's yes, with a few exclamation points behind that.
Right.
But yeah, and we are coming back. If just we can get that vaccine going, then we can get some of the small businesses and restaurants back up and running. At least the ones who are able to survive it.
Hmm.
I think we'll do pretty good.
Hmm. Absolutely. Well, let's jump into to some charts here. Um, I I've enjoyed showing lots of charts throughout the year, so we're just going to keep that up as we go into 2021.
It's a good idea. I like charts. It's good to see things visually as well as just talk about something.
What we have up here on the screen is looking at various indices, actually pulled out specific investments people can go into that are tracking various different things. So let me just quickly run through what we're looking at, what the colors are. So the purple is emerging markets. The orange is total U.S. stock market. We're going to see that show up on a couple different charts here. We've got the blue is developed international stocks. Then we have the S&P 500, which most people view as the market, although as you can see, there's a lot of different things here that are all part of the market. But the S&P 500 is in green. Then we have in that fuchsia color is a total bond market. And then we've got gold price. A couple clients reached out after our last couple investment review and outlooks and said, hey, I know we have some gold in the portfolio. Let's add that to a chart. So we've got all that here. So what we're seeing is the full year, 2020 from January and the percent return over a period of time. And you can see right there in March, the major drop. But everything ended the year up from these at least, and there are some sectors that weren't up. But bonds, you can see that fuchsia is pretty steady, ends up 5%. The best performer was gold, but stocks did pretty well. We're going to dive a little bit more into these numbers, but is there something that you see when you look at this?
Well, I think, Ben, what I see is that there's two of these lines on here for bonds and for gold. And you can see, although there is certainly some correlation with both of these, I mean, particularly in gold, but you can also see, I mean, one of the big reasons why we own gold is that it's long term, low correlation with the stock market itself, because you look back to March and April, yeah, gold went down just a little bit, but look at what the whole market went down. And so gold right there was a tremendous diversifier. And in fact, over the full year, gold, because it hardly went down at all in March and April, it did very well. And for the whole year was up just under 25%. Now, I wouldn't expect gold to do that again next year. We didn't own gold or buy gold because we thought it was going to go up 20 or 30% every year. But we own gold because it's a great diversifier with a long-term record of of positive after inflation gains, but it goes down some years as well as up years. And we own it for the long term, not just because of one year. And frankly, I would be surprised if it is our top performer next year, but who knows? Yeah,
Right.
but it's a great diversifier, and same thing with the bonds. Steady, mostly income there, although this year that 5.16%, some of that is some capital gains
Right.
because interest rates went down a bit. When interest rates go down, it pushes the price of bonds up. So we got some interest and we got some capital gains. I'm not sure, and I wouldn't want to bet that we'll see a 5% gain in bonds this next year. But again, bonds along with gold are two great diversifiers for our portfolio.
One thing I'll add here, and then we'll see that diversification effect here on the next one, but it also jumps out to me the um, the blue that we have, the developed markets, so international stocks, and that's the worst performer of those stock market funds. But you can see that it goes all the way until November before it's up for the year, until it crosses that zero line. And we saw the U.S. market really come back quickly from the bottom overall, and eventually international did as well. We had some clients, late spring, early summer saying, why do we keep buying some of this international when we're rebalancing the portfolio? And it's all about, we have no idea which one of these lines is going to be the best going into next year and in any period of time, but we own it all. And that's to rebalance between, and eventually, we do hope that every investment we have goes up over time. That's the goal, but we don't know the timing of when that would be. Let me go to another slide. What we can see here is first quarter, going back to that diversification effect, and the numbers you actually have here is the percent off the high. And a lot of clients, and I think it's just natural, a lot of clients kind of anchor at that high point. You read the news, you get headlines when things hit a new all-time high. And when you have losses, although we've never sold at the top, never planned to, honestly, it's anchored in your mind on what that is. And so when you see a drop of this level, even at the end of the first quarter, all those things are down almost 25%, except for we have the gold and we have the bonds. That is exactly what you said. I mean, that was scary. That was pretty bad. We got a lot of client calls at that time.
I'll bet you did. Even with all my years of experience, on March 23rd, I was kind of scared.
Mm-hmm. I remember we talked on March 23rd, and I remember that just because it was the bottom, and there were some things we were doing, but we didn't know then that was the bottom.
Yeah.
No one did.
Yeah.
No one did. The next slide that we have here is same one. It's percent off high, and this is showing the full year 2020. Now, this could be somewhat confusing because once the number hits the high, it's a new high, and so we're just looking. But what this jumps out to me is saying U.S. stock market ended at the high. That's what the 0% is telling you. It closed the year at the high. And we are close to the highs for emerging markets, for developed markets. These are all-time highs that you're seeing. And that's how we go into 2021 is most of these are all-time highs. Gold is off about 9% from the high. But as we saw in the previous chart, it's still up quite a bit for all of 2020. This is something that then leads clients to say, as we look ahead to the future, do we need to sell? Are we worried about what could actually happen there? And that's natural. People don't want to be stuck in and see things drop. Most of the time, you would expect that you are off of the high. I think that's maybe something people don't think about, but very rarely are you just sitting when you look at your portfolio statement and it's the highest it's been that full year. So just to kind of close that up, here is just another way to look at those same numbers. This is the market summary we've got in 2020. And I mentioned there are some things that were down. Global real estate was down 9%, which it was down quite a bit more than that at the low. And that makes some sense that you would expect that. But it was a great year for stocks overall and for bonds in that case. And then if you look over the last 20 years, just some of those numbers down below, obviously U.S. stocks being up 21%, that's way above the average. But you can see, maybe even more importantly than the average, look at the best and the worst years and how big year over year things can change. And obviously worst year for a full year was 2008 for stocks overall. But you can see the diversification effect and the balancing of the portfolio. Just look at the worst years for bonds over the last 20. The worst year was 2013. And the overall U.S. bond market was down 2% versus emerging markets in '08 down 53%. What else jumps out to you?
Well, again, all I can say is diversification. I know people are probably tired of hearing us say that, but it works, and it works whether you want it to or not. Because, for example, the last chart that you had up percent off of highs, their gold was the worst off of the highs, down 8%. But gold was our best performer overall. And again, same thing with the bonds. Uh, you don't get the big ups there, but you also almost always avoid the big downs.
Mm-hmm.
And I know that emotionally, people want to see, particularly when the stock market is going up, they want all of their stuff to be going up, just like the market. If it's up 20%, everybody wants to see everything in their portfolio up 20%. It just, if we could do that, boy, Ben and I would be doing this broadcast from our 400-foot yacht in Monte Carlo Harbor, and we're not there yet. So,
We
you
are
know,
not.
I mean, you can talk all you want, but diversification works. And that always means when things are going well, you're going to have some stuff that doesn't go as well, maybe even be down. But when the market's down, if you're properly diversified, you're going to have some stuff that's down nowhere near as much as the whole market is down. Some stuff may even be up. But the whole idea is you combine those together and you have reduced the risk in your portfolio a lot. And management of risk is where we come in and really earn our money. It's not because we picked the hottest stock.
Mm-hmm.
The plain fact is nobody can do that consistently over a long time period, and we sure can't. But we can manage risk, and I think we're pretty good at that. And clients had a very, very good year
Mm-hmm.
last year, and we can't guarantee what's going on, what's going to happen going forward, but we sure can do a pretty darn good job, less than perfect, but a pretty darn good job of managing risk.
Mm-hmm. Absolutely. And I think that leads us into here as we look ahead to 2021. There's two broad risks as we've talked about the last couple ones of these that we put together. One side is the risk everyone I think intuitively worries about, which is losing money, and that's deflation, maybe contraction in the economy, and recession, drop in the market, any and all of those things. Losing money in stocks is kind of what everyone goes to. That's a risk, and we've talked about that, and it'll always be a risk. If you're invested in stocks, that is arguably the biggest risk that you have, and you have to accept.
If you're invested in stocks, there's going to be certain times you are going to lose money.
Right.
Period. And we can help to reduce those losses, but we're going to have losses too.
Exactly.
And you have to have a long enough of a time frame for anything that you're willing to put into the stock market, that you don't let one bad year scare you out of the market. Because if that happens, you should have never had that money in the stock market in the first place.
Exactly.
You should have had another part of your portfolio that's not invested in stocks and isn't going to have the risk of a big loss in one year. But if you're in stocks, you're going to have years the market is going to lose, period. No way around it.
And it could be multiple years. And our general philosophy, I mean, it changes. It depends on, tweaks on the edges. But overall, our philosophy is if you're invested in stocks, you should just plan. You're not going to touch that money for 10 years. You should not invest anything into stocks that you say, I'm saving for a house in 3 years. Maybe I should invest in stocks, make some more money. There is absolutely no guarantee at all that it'll even be at the same level, let alone up when you need the money. There are no guarantees, but the longer you can invest, the more likely it is that it'll be there, and it will be at least at the level, if not higher. But that's our general philosophy. Stick with the safer investments, the bonds, the cash, the things that you actually are going to know are going to be there if you need the money. And that's what we're going to invest in. Everything that's in stocks is 10 years plus from a long-term investment.
Ben, I'm thinking of buying a new home in a couple of months.
Yeah.
Should I put all my money into Tesla? So that way I won't have to get a mortgage because it'll probably triple in the next few months.
Did you see that Wall Street Journal article that there are, there are people doing that?
Good luck to them.
If that is what you're looking for, we are not the right right company and right advisors for you.
Okay.
That's for sure.
Well, in case there's anybody watching this that isn't familiar with my sense of humor, that was a joke. If you missed that.
Thank you, Gary.
I just wanted to make sure, Ben, that you knew that it was a joke.
That I did know that was a joke. That was good for compliance purposes. I appreciate you.
Okay, good.
That comment. So the playbook for deflation, for those risks, that's kind of been played out and written over the last 100 years. That is diversification. We've talked about that. That is make sure that you don't have anything short in stocks that you need in the short run. That's rebalancing the portfolio. It's not letting emotions get in the way of your investments. That we've talked about. As long as you've worked with me or Gary, you've heard us say all those sorts of things over the last several years, but in terms of these videos, the last couple of videos you and I have done, we've talked more and more about inflation as another risk that's out there. And so we want to touch on that as we look ahead. We have both of those risks. You have the deflation risk, but you also have the inflation. And we want to be prepared for both because we don't know which way this is going to play out. But when we're talking about investing and looking to the future, both of those scenarios are very possible, and we need to be prepared for what that looks like. So go ahead.
Yeah, I think, you've heard us. I think we've talked on one or two of our other telecasts here about a barbell portfolio. And that's what we're doing. We want a portfolio that's got some investments in it that are good protectors against inflation. We also want to have in our portfolio investments that are better protectors against deflation. And because we really don't know what is going to happen. Personally, I think the risks of at least somewhat higher inflation are somewhat higher than they've been the last few years, but I don't know that for certain. And I don't want to put my whole portfolio into an inflation fighting stance when I could be wrong. And we think, again, management of risk is to have some investments that are good protectors against inflation. That would include gold. That would include real estate. That would include a number of stocks in the stock market. Mm-hmm. For deflation, bonds are a better protector there, and many stocks will perform under either scenario. We want to have some money in the stock market. Now, the amount that we would recommend to be in the market can vary, but yet under either of those scenarios, we think a portion of your portfolio ought to be in stocks.
Mm-hmm. Absolutely. So let's take a look at some of the things that we see on why, inflation, although not certain, is a little bit higher risk than going back a number of years, I think. So let's take a look at this first one. So I think what you can see here is going back to the beginning of 2008. Um, this is looking at two things. So U.S. public debt, which is now, as of the end of the second quarter, was over $26 trillion. And then comparing that to the Vanguard Total Stock Market Index that basically is looking at U.S. stocks. While CPI, Consumer Price Index inflation, has been running very low, there is absolutely an inflation that's been happening, and that is in asset prices. And you see that here. There's definitely some correlation between the level of public debt and U.S. stocks overall. And I will say, if we look back, I know we were concerned about deflation, recession, some things all the way back to 2012 as a possibility. But as this debt level continued to rise, and for various reasons, that has continued to lead with, not in a straight line, but things have gone up pretty well over that period of time. I want to dive in a little bit more as we talked about last year. So as we look at this chart, this is showing just percent gain from the beginning of 2017 to end of the year. But as you can see, um, we've got this big jump in stocks right at the same time, coming out of the stimulus that just adding more debt levels, and there really isn't an end in sight on this. So with the Biden administration, does not look like we're slowing down the level of debt. We know there's stimulus that was just passed. Sounds like that's going to be increased from $600 a person to $2,000 with the recent election. So with that, this level of debt's going to keep rising. There's no guarantee that the stock market's going to keep going up with that, but that very well could happen. And that's one reason, while we're concerned about what this will mean long term, that's one reason why we definitely should not be selling out of stocks, because we think we can predict what's going to happen. Clients always want to ask, so what's going to happen? Where are markets going to go? And I think I mentioned to you before we started recording, Gary, 74% of the time of years stock market's up. So that's probably a good percentage. There's probably about a 3/4%, three quarters chance that markets will be up, and maybe a quarter that it'll end the year down. That's about as good as we can say at this point. We don't know where it's going to be.
Yeah, I think that's very true. I guess what I will just add, and a real concern that I have, is that line showing the increase in the debt of the U.S. government. It's gone from under 10 trillion up to what, 26 or 28 trillion.
Exactly.
And it's going to go a lot higher, as far as I can tell, over the coming years. And at some point in time, that's going to hurt us, because our increase in debt is going up at a much faster rate than what the economy is going up, the gross national product. And that can't go on indefinitely. We've certainly seen that it can go on for a number of years, but if you aren't increasing your ability to pay back the increasing amount of debt that you're generating, you're going to have a problem at some point. Now, the U.S. has completely avoided that because we have the fiat currency of the world, the U.S. dollar. Practically all trading in the entire world is done in the U.S. dollar. Everyone looks to the U.S. and trusts the U.S. to be the economic leader in the world. Well, there's no guarantee that that will continue that way. And I'm not predicting that next week that the world is going to lose its faith. But if we continue to produce debt levels that are in excess, and well in excess of our ability to pay that back, at some point in time, there's going to be a problem. And believe me, that will be a time that Ben and I will be doing a bunch of meeting and scratching our heads and talking about how should we be reacting to that situation? But we're not there. I don't think we're close to being
Right.
there. So it's not something I'm worried about this year, this month, or next year. But could it be a major thing in the next 5 to 10 years? It could be.
Mhm. Mhm. Absolutely, and it's something that it's part of why we're bringing it up now, just in anticipation. Not that we need to jump in and do all these crazy things right now as investors. At the same time, we need to be aware of the risks that are out there, and this is uh, definitely not certain. There's not just one line on how this could actually play out. There's a lot of factors that go into it, but given where things have been the last decade, and as we've seen recently, you're right on in that the debt level is not going down anytime soon. It doesn't look like. And what does that mean?
Yeah, and I would just like to add, I mean, part of the reason, certainly over the last year or so, that we've had a particularly big increase in it, well, a major part of that short term increase is due to what we're doing to try to save people from not being able to pay their rent, from keeping small businesses open. And I'm not trying to say that we shouldn't have done that. In fact, I completely support helping people, because it wasn't anybody's fault that this virus came along. And we absolutely support the short term thing. So, again, that people can buy food and pay the rent and so on. But our debt problem goes way beyond what has happened just in the last 12 months. And in the next 12 months, the debt issue is going to get worse, because we'll probably do another stimulus type of a thing. And again, to try to help those people, particularly in the lower end of the economy, we should be doing something like that. But my point is, our increase in debt goes way beyond just what we're trying to do to save people in the shorter term.
Absolutely. Absolutely. So as we look ahead, just want to kind of recap everything that we said and put a nice bow on it. So I've got a few more things to kind of walk through as we look for this year and many years into the future. So I want to start here um, and just take another look at what can happen in a diversified portfolio, having 60% stocks, 40% bonds. And this is more that deflation side that we talked about. It's very possible that you have a major crash. In this, you can see that after 1 year, that's all the numbers in blue. It's kind of a mixed bag. After you have some sort of crash, or you have the bankruptcy of Lehman Brothers, U.S. debt downgrade, in different scenarios, markets may be up, maybe down over a year. Looking ahead, once we are able to stay invested and maybe even rebalance the portfolio at 3 years, at 5 years, looking at the last several, you end up pretty well. and where that's part of what we're doing. We want to have a balanced portfolio so you don't lose as much on the way down. At the same time, you're positioned to still make money on the way up. None of this is guaranteed, but we feel pretty good about the ability to respond with the portfolio in that type of scenario.
You know, what I would just add, it goes back to what you said, Ben, about the money that you should have in the stock market is only long-term money. And this, I couldn't do a better job of illustrating that even when we have bad times, when we give it time,
Mm-hmm.
the market will come back. And why do I believe in that? Because what the market is reflecting is the dynamism of our capitalist economy. That's the biggest factor in our economic success.
Mm-hmm.
And that we have those uh, entrepreneurs that go out and start small companies and they build them to big companies. It's the Bill Gates, it's the Bezos, it's even Elon Musk and so on, although I think that stock is somewhat overpriced. But there's hundreds and thousands of other great entrepreneurs that started in their bedroom, in their basement, in their garage, and are in the process of building great companies and did in the past. And there's no reason why that isn't going to continue. And it takes a while. Bill Gates didn't build Microsoft over 1 or 2 or even 5 years, but boy, did he build it. And a great company that changed all of our lives for the better. And so, they're out there, they're doing the same sorts of things now. And that's why we believe in our economy. And it goes up and down. It doesn't always go up. Humans run it, so mistakes will get made.
That's
And
right.
they do all the time, politically and, within companies, because not every company succeeds. And that's a good thing in reality, because better companies will outdo the companies that aren't well managed, and they will take over, and some people go bankrupt. And going bankrupt it's a part of a dynamic economy.
Absolutely.
Creative destruction is the name of the game.
That was great, and I think we've got a few more here that'll kind of highlight that as well. But one other piece that we've touched on earlier is just what happens after new highs. We saw that percent off high, and people anchor in that. We know that we're at all-time highs in the market now. And so it's natural to say, should I sell? And this is just looking, again, at numbers we showed a little bit earlier, but S&P 500, after you hit a high, should you sell? And the answer is a resounding no. If you're a long-term investor, stay invested. After 1 year, the average return after hitting a high is 14%. Even looking out 5 years, if you just always bought at the top, you're going to be okay in the long run if you stay invested long enough, because of the capitalism, because of things continue to grow and improve overall. So 5 years, 10% return in stocks, I think we'd all be pretty happy if you could just get 10% a year over the long run.
Ben, where do I go to sign up for that?
You go to your Schwab account and you stay invested.
Yeah, there you go. You hit the nail on the head. Then all I have to do is just sit in my lazy boy, and I should be okay over the next 5 years.
Just forget your password and you're good to go.
Okay.
But it is, just another way to look at this is the importance of long-term discipline. Going back to that same time period, beginning of 1926 to 2019, S&P 500, that stocks did 10% a year versus short-term treasury bills 3% over that time period. Wouldn't that be great? But there's that period of time in the middle, about 16 years from 1965 to 1981, where 1 month T-bills actually did better than the S&P 500 over that same time period. Now, that was a high inflationary time period. That was part of it. Part of it was interest rates. There's a lot of factors that go in there. It's not so important on why that happened. What matters is that's a long time for bonds to do a whole lot better than stocks. And I could see that it would be really tested, your patience and your conviction in investing in stocks over that time period. But look at the subsequent years, 1982 to 2019, that reversed, and you had almost 12% return in stocks versus 3.8 for bonds. Long-term investing, invest across multiple areas. You never know what's going to be the best. And overall, we expect stocks to do better, but there's no guarantee on that.
Yeah. And I would also say I probably wouldn't expect to see bonds do as well over the next 5 years as they have done over the last 5 years, because interest rates were really going down. And when interest rates go down, it pushes the price of bonds up.
Hmm.
As we talked about earlier this last year, with our bond return of 5.16%, that was a combination of our interest that we earned plus capital gains. Going forward, I don't think we're going to see much in capital gains, and we could see some capital losses.
Hmm.
But still, bonds are nowhere near as volatile as stocks, and they are a good diversifier for a portfolio, although I don't think we'll see the kinds of returns as we have had over the last few years.
Hmm. Right. There is so much money that's invested in negative rates around the world, and yes, the U.S. could go negative. I don't personally think we will, but it's possible. But even if we do, there's only so much capital gain, so much up that bonds can do when you're starting at such a low base. So I think it's definitely worth considering. But we're not selling, so let's stay invested and balance of the portfolio that you have there. Um, and this is a big part of it. So we've talked about this in so many ways over the last 10 years on the impact of volatility, and how if you can limit losses in the portfolio, you don't have to make nearly as much. And that's the purpose that bonds play in the portfolio. So this is just showing hypothetically $100,000 portfolio. And let's say in year one, you make 50% on the first one and only 10% on the second. But year two, you lose half, you lose 50% in one and you lose 10% in the other. You have the same average return that averages out to 0%. But if you actually look at the numbers, because of the level of losses, and losses hurt more than gains help you, you actually end up in both scenarios with a negative return. And you actually have you've lost a quarter of your money in portfolio one because you weren't able to limit that loss. So the upside's great, but more important is to limit the downside, and you don't have to make nearly as much and be in a good spot.
Makes sense to me, and it's true. That's part of managing risk.
Did you know this was the next slide?
No, I did not.
So what can we do? We can manage risk. We make a plan that you can stick to that has the risk you need to take paired with the risk you're willing to take. And Gary, I know you have always said you should take on the amount of risk that you need to reach your goals, no more, no less. And
Yep.
that's exactly what we're trying to do for individual clients, for what you need, what goals you have. Make sure that you've got the cash available when you need it, and you're able to invest long term for the things that are truly long term. We want to make sure that we've got the dimensions of expected returns. So that's where we didn't talk much about it here, but things like small cap and value and high profitability, those are things that historically have done pretty well, and there's reasons for that. So we add that as a little piece, but you still own the overall market. We own not just US stocks. And we go back to one of those earlier charts where you saw it took all the way until October for international stocks to do well, but they did pretty well here at the end of the year, and you had some nice returns globally. It's tempting to say, well, US is the place to be, let's sell everything else. We want to invest globally. You've had a nice couple months here for international stocks, especially as different countries are opening up in different ways because of the virus. We want to make sure we manage the expenses. You're not paying too much in fees. The mutual funds, we use a lot of dimensional funds, and they actually just lowered their fees a lot. That's something we're excited to see, because that's more money back into clients' pockets, less turnover in taxes. Taxes could go up, both on capital gains and just overall tax rates. If we can manage the portfolio that we know exactly the way the taxes are going to impact, that this type of investments taxed this way, put it in the right account. I think that's really important. But more important than anything else is probably just to stay disciplined, invest for the long run, and don't focus on the short term.
Makes sense to me. What I want to comment on this is simply that we actually do not maintain a 60-40 portfolio.
Mm.
And that is because we have added other investments, gold being a major one, REITs, these are real estate investment trusts. They are not included in the straight 60/40.
Hmm.
We also have some tips in your portfolio, the Treasury Inflation Protection Securities, which are not included in this at all. And the fact is, and I'm sorry that because I was thinking about this when you had this up on the screen, because we really don't believe in a straight 60/40 portfolio, even though that does give you some good diversification. We believe that there are more things that needed to be added into that portfolio. Again, gold, real estate, TIPS bonds that are great for protecting against inflation. And we may add other things in
Hmm.
future years. We're always doing research on different things. But I think the straight 60/40 portfolio is outmoded. And the real fact is, we haven't used that going probably for 15 to 20 years. I mean, a straight quote unquote traditional 60/40
Right.
portfolio, because you can be more sophisticated than just a 60/40 portfolio. And to me, the greater sophistication is what we can do better in managing risk.
Hmm. Absolutely. It's a combination of diversification and the managing risk, and um, pairing again with where clients are. The 60/40 is quoted a lot in the media of, a balanced portfolio or average portfolio. There's a lot of financial advisors that just kind of stick with that allocation as it's written here. So there you'll see that a lot, but you are definitely correct in pointing out, we're not just buying 60% global stock index and 40% global bond index and moving on.
Right.
So great. Well, any other kind of closing comments?
Um, Not really that I can think of looking at my notes here. No, I do have one thought. Ben, you had said some clients had talked to you about the fear of that the stock market was so overpriced
Hmm.
right now. And I think that there are stocks in the US market that are overpriced, but there's always stocks in the market that are overpriced. I think, particularly now, tech stocks have really taken off and are up a whole lot. And there are some of those tech stocks that are overpriced. Yes, there's no question about it. But over the last quarter or so, because I've been interested in some of these tech stocks and wanted to learn more about them, because I'm certainly not a tech analyst or anything. But in doing that work, I have found that there are a number of absolutely tremendous companies in the tech area, in software, in hardware, so many different areas that frankly, I'm really excited about them. And I think they have some tremendous future. Uh, Are some of them overpriced now? Yep, I totally agree. If I was going to be buying individual stocks, which I'm not really to hardly any degree, but if I was, some of these companies, boy, I think they're tremendous companies, and their stock price is going to continue to go up. Again, some are overpriced, but that's one of the reasons why I'm optimistic going forward. We talked about all of these entrepreneurs. Well, there's plenty of them out there,
Right.
and plenty of them that are beyond the bedroom, basement, and garage stage of building tremendous companies. And that's going to be going on over the next few years. And I'm very optimistic about that.
Hmm. I think that's a really good point, and it's really easy to paint with a broad brush and say, this whole sector or this whole industry is overvalued or undervalued or anything else. Um, we are not individual stock pickers. We're investing in overall markets, But the importance of what you're saying is, yeah, there's definitely stocks that are overvalued. Some of them we'll only know 10, 15 years from now when you look back and you point to them. One you've talked to me about is Cisco in the late 90s that you thought at the time it probably was overvalued, but more important was have a diversified portfolio
Yeah.
and invest across not just tech stocks but value stocks and different areas in the market. It's the
Yeah.
same thing today. We're not predicting any individual stock. Gary and I may joke about a company here or there that we should short or otherwise, but when it comes to actual long-term investing, it's less important of did you pick the hot stock or avoid the loser, but more importantly, did you own the overall market? Because if capitalism works, then things are going to go up, entrepreneurs are going to make money, things are going to get better, and we want to have our clients invest in that and experience that.
Right.
Great.
I've said, I think, all I got to say.
Okay, that sounds good. Well, Gary, always great to talk to you.
Yep.
And we will be back at least one more time this quarter.
Yep.
Sounds good. Take care.
Very good.